The latest inflation figures came out and they were even worse than the record-breaking numbers we saw last month. Inflation for last month came out to be 6.8%, which is the highest level seen for 40 years. The crypto markets and stock markets had a mixed reaction, with investors being relieved the numbers were within expectations, however with the large majority of markets continuing the trend in going risk off, the most notable being the Bitcoin and crypto markets. One investor who is raising the alarm bells about just how pernicious and serious these extremely high inflation numbers are was Chamath Palihapitiya. In his latest interview, Chamath explains why the inflation numbers are actually much worse than expected and why we can expect the trend to continue long term. Chamath argues that governments are moving the goalposts and manipulating inflation figures to sweep under the rug how bad things are getting. Worse too is that investors are now stuck between a rock and a hard place, looking to go risk off yet wanting to somehow hedge against the onslaught of money printing. Make sure to stick around to the end of the video where I will cover the latest on-chain Bitcoin data to see how Bitcoin holders are reacting to the latest figures. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
I think we did a pretty good job of unpacking the Great Resignation. I think it was last pod. So, right? Remember, there are three structural issues at play in the jobs front. One is that you have this really meaningful under-immigration that's happened because of Trump. The second was you've had a big mismatch between the degreed classes in America and the jobs that they can have for what they think they should earn, meaning you go to school, you get into all this debt, you try to become a teacher or something, and then you realize you can make more at an Amazon warehouse. Crazy.
Strange.
And then the fourth is you have all these boomers with an enormous amount of savings, 30, 40, 50 trillion dollars, who are pulling forward their retirement and also subsidizing their kids. You put it all together, there's less of an incentive to be in the job force unless you pay higher wages. Now, let's just put a pin in that for a second. I think the thing that Sachs talked about is really important, which is that we have to really figure out whether inflation is transitory or it's persistent and it's here. And I just want to bring up, Nick, I'll send you these the Twitter links to this, but Bill Ackman tweeted out these two things today, which is that if you...
Fan of the pod.
Brilliant investor, by the way. Great human being, brilliant investor. Two very specific things. He actually called out something that we also mentioned before, which is that CPI is horribly calculated and it's really imprecise. And if you unpack CPI, there's something...
Price Index.
The Consumer Price Index. There's something in there, a component of it, that's very important, which is called the owner's equivalent rent, right? How much can somebody basically charge rent to other people? The way that they calculate that, which is 30% of the calculation, is they just survey a handful of people. The problem is you don't need to survey because the actual exact data is available from single-family rentals that report this number. So their survey showed basically a much, much smaller increase than what the actual increase is. And let me just give it. So the largest owners of nationwide single-family rentals are reporting a 17% year-over-year rent increase.
Wow.
The OER that was calculated, quote unquote, by survey in the CPI was 3.5%. If you flow that through, it means that core CPI actually went from 4.9% today to actually 9%. And the CPI print, which was 6.8%, was actually 10.1%. So it just goes to show you we have sources of data that the government is not in a position to collect or measure. We have horribly inaccurate econometric models that we use. You know that phrase sort of shit in, shit out. So unfortunately, you get very bad...
Garbage in, garbage out.
You get very bad, crappy data. And now all of a sudden we're printing numbers. We're supposed to make policy against those numbers, but the numbers that underlie this decision-making is fundamentally flawed, and it's flawed in the wrong direction. The other thing that we talked about is that the Fed basically changed the government changed the rules on the percentage, basically what qualifies as a conforming mortgage. Remember that? And so now that's basically at $1 million. And if you think about it, most Americans, 80 to 90% of their true underlying wealth is their home, to the extent that they build, a positive net worth. And if you all of a sudden, push up the upper bound on what a conforming mortgage is to $1 million, that effectively means, it's roughly about 20%. That effectively means that you're moving people's net worth up by about 4 or 5%.
That's right.
And so if they take that and then they take that money out of their home via a HELOC or an equity line of credit, right? Home equity line of credit. And then, to your point, Friedberg, they spend it or they invest it or they, it could be a real disaster scenario in 5 or 6 years' time.
By the way,
no, this is more like 1929 kind of crazy.
Yeah.
There are a lot of institutions that must own some of these inflation protected assets. So we were already in a negative yield environment. What are those folks supposed to do if they have to fund an 8% return a year to pay the pensions of, good people, firefighters, teachers, it's, you name it, policemen, etc., right? They were forced to invest in the kinds of funds that would then go out further and further out into the future to buy the promise of future cash flows. And when all of a sudden a whole bunch of other assets that they held, which were supposed to be safe, implodes on them, right? Because all of a sudden inflation changes and the front end of the yield curve goes whoop, and all of a sudden all these assets, when yields go up, prices go down. Now the fireman's pension is like, oh my gosh, we just lost all this money we never thought we were going to lose. And we're long all these, crazy tech stocks. And so then they're forced to sell so that their overall exposure goes down. That's called degrossing, okay? And we've been going through a very painful process of this degrossing. Hedge funds are doing it in droves. The problem with being a value investor over the last 15 years, since 2008, is you were basically a dumpster diver. And you got paid absolutely, you didn't make anything because they misunderstood what value was. Value isn't necessarily things that are cheap. Value is things that are valuable. And over the last 15 or 20 years, what was once a question is now definitive, which is that the things that are valuable tend to be technological because they're super high margin, they grow really quickly, they compound, they create enormous cash flows at scale. So the point is you couldn't own that stuff. And if you sat on the sidelines, you weren't meeting your 8% hurdle. You were all of a sudden looking at some risk of defaulting on your pension obligations. So this is how this whole cycle brought us to today.
So there's Chamath on why the inflation numbers are even worse than they seem on paper. Inflation being measured by CPI is a terrible metric to judge loss of purchasing power, and it's interesting to see other notable investors such as Bill Ackman point it out. It's something Bitcoin investor Michael Saylor has been telling people for a long time. True inflation is much worse than the CPI numbers being put out. Now, to look at some of the latest on-chain Bitcoin data to see how Bitcoin has reacted to the latest inflation numbers, out from on-chain analyst Will Clement, he shows his supply shock ratio overlaid with the Bitcoin price. As you can see, one difference of the pullback we are currently seeing in comparison to the massive liquidation cascade we saw back in May is that supply is moving to entities with a very low spending behavior. To me, this is a reaction from long-term Bitcoin holders and believers continuing to stack sats at a discounted price as a hedge against inflation. If you are a believer in Bitcoin as a proxy for gold and a superior inflation hedge, then there has been a no better time to add to your stack. Anyway guys, hope you enjoyed today's video and that provided you with some value. I'll see you all in the next video, and as always, have a great day.